Hi, I'm Steve Van Metre. Welcome to your weekly economic update where we take a longer look at what's going on in the markets and the economy every Friday with no real time limit, but usually it's about 30 minutes in case you're wondering. Sometimes a little shorter, but not much longer. Anyways, we had Quadruple Witching Day today, which is essentially just a fancy term for options expiring on the market. It doesn't mean witches are flying around and there's not four of them. It's just there's four different types of major option contracts expiring today. And that was a lot of excitement because usually it means there's a lot of price volatility in the markets, a lot of trading going on. And we saw virtually none of that, which is pretty interesting because all I heard about all week from various traders was wait till Friday comes, something interesting will happen. And well, yeah, there's some interesting things, but not to the level that people were thinking. So in this week's update, when you read it, we're talking about the monetary lags. And it's really interesting when you listen to what the Federal Reserve is saying. Fed Chair Powell is pretty much saying, well, there's going to be some weak data due to the government shutdown. And then by the second quarter, that's going to pass, which is odd because the weak data started in December and the government shutdown wasn't until the end of December. So I don't really understand how virtually 1 week-ish of a government shutdown creates a whole month of, well, I can't spend because of uncertainty. It doesn't make any sense to me because it doesn't make any sense. The reality of the situation is when the Fed tightens and reduces the money supply and they tighten monetary policy and interest rates go up, all of these things occur. So you have an economy where the amount of money is not growing as fast and the cost of money is rising, i.e. interest rates. Simple things like, let's say there's a young couple who's renting an apartment and they decide to go buy a home. And so they go, hire a realtor and go around and find out, these homes are too expensive. So rather than buying a home, taking out a loan and then doing what most new homeowners do is decorate their homes, furnish their homes and, do other things to their homes. Maybe they just go buy a new sofa for their apartment and a new TV and say, well, I guess we're stuck. And what happens is that lag of not buying that home means the realtor doesn't get paid, the lender doesn't get paid, the appraiser doesn't get paid, the inspector doesn't get paid, the furniture store is not making a big sale, the painter's not getting some work, the landscaping isn't getting, money put into it. So you look at all these things and all of these jobs that are not created, eventually that lag pushes through the economy. So the more and more people who aren't out, say, buying homes, buying cars, financing big ticket purchases, those lags just stack up and stack up and stack up in the economy. And the same is true with large corporations. So let's say I was going to go build a factory tomorrow and I decided, well, business is slowing down, the cost of the money is too high. Whatever the situation is, I decide not to go build that factory. Well, there's a lot of jobs and a lot of things that over time are affected by that. And that is to be expected. So while the Fed right now is focused on the government shutdown, the reality is what we're experiencing is not only the lags from the Fed tightening, because the lags are more than 12 months back. You have to go somewhere between roughly, I think 14, other experts say 18, we'll just say somewhere between 14 and 18 months. Things that happened back then are showing up in the economy today. Plus the second factor, if you really look at this, is the tax cut. That's filtering out of the economy and right around, I thought, October-ish. And sure enough, November, the data started to slow. December, it really started to slow. And so you have this double whammy of the Fed tightening and the fiscal stimulus going away. And that just causes the global economy to slow down. And so the Fed thinks this is going to go away in quarter two. I really don't think that's going to happen at all. Now, there's some interesting things that are going to happen next week. One is corporate share buyback blackouts, say that 5 times fast, is going to start kicking in. So the biggest buyer of stocks right now is going to start disappearing. The second thing that's going to happen is the Fed's going to meet. The third thing that's going to happen is the Fed's going to destroy about $10 billion worth of money. So the market, which has been, boosted by corporations buying back their stock at twice the rate they did last year. Not that they have twice as much money. They still have the same amount of gas in the gas tank estimated, where nobody's sure exactly, but they've got to pedal down even farther. They're racing to the first quarter because they know the first quarter earnings are not going to be good. Their stock price is too high relative to where earnings are going to come in. And so these executives are trying to cash out as quickly as possible. And you say, well, how do you know that? Well, they're required by law to publish when they sell or buy. And all they're doing is selling. And they've been selling for weeks and weeks and weeks now at a really rapid pace. They're getting their money out of the market. Now, there are some rumors swirling about what the Fed is actually going to do at the end of the year. But before we get there, the content of this video is provided as educational information only. It's not intended to provide investment or other advice. This channel is not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, our own personal capacity. His opinions expressed this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Now, I'll give you my opinion. My opinion is the Fed does not want to stop quantitative tightening. They do not want to stop their balance sheet unwind because they know the global economy is slowing and they need as much ammunition. I mean, you have this whole entire 10-year period where central banks have pumped money in the global economy trying to reignite it, and it's failing. Now, what do you do when it fails? You've got a problem. You've got a huge, huge problem. So the Fed's trying to build up some ammunition, and they just don't have very much. So my bet is that they're going to come out at their meeting next week and tell us they're going to slow or they're going to hint at a potential stoppage of the balance sheet unwind. And they're going to do this because they believe that the second quarter data is going to improve, and they just need to push investors through this because they're trying to avoid a big stock market sell-off. Not that the Fed can actually stop one, but they can jawbone long enough until the data becomes really clear and corporations run out of money, as they've done in the last two recessions, where they just couldn't prop the market up anymore. But the Fed is a confidence game, and they need to give the market some confidence that we can still tighten and everything will be a-okay. So the rumor is that they're going to actually announce a tapering of the balance sheet unwind by the end of the year. Now, it'll be way too late because what happened last year, we saw the Fed unwind the balance sheet and raise rates, which is going to be roughly equivalent to how much they're going to unwind this year. I don't think they're going to raise rates this year, but if you look at how much each interest rate hike counts as a monetary tightening, you can do a little math and say this year and last year will be about the same. And what happened last year? The stock market went down at the end of the year, and that was after we had this huge fiscal stimulus called a tax cut. We're not going to have a tax cut this year. It's gone. So all we have is corporate share buybacks, which based on what we know last year means the stock market should again end the year lower. The only question is, when will that trigger? And I think it could be May or June. It doesn't mean I think it's going to go shooting straight up. A lot of people do. It may just go down or a little or be flat. But there's going to be a point this year where these corporations run low on money to buy their stock back. And without them, there's no one to hold the market up. So it'll be kind of really interesting to see what the Fed does. But again, confidence game, I think they're going to do whatever they can do to keep investors buying risk assets because they know when stock market's up, people tend to spend more. I mean, that's kind of a long-term fact for the Fed, and there's a lot of truth to that. In the end of the day, they know the system isn't working, and they need all the ammunition, and they don't have enough. They can lower interest rates back to zero. They can put the balance sheet right back where it was, and that's not even a fraction of what they've done in prior recessions. So what are they going to do? I don't know. But anyways, that is kind of my thoughts on where I see the Fed and their announcement for next week. So let's go jump into some charts, see what they look like. M2 money supply is headed back down, as we've discussed would. This is down 4.04% year over year. The growth decreased by $7 billion. The 6-month rate of change increased slightly, but that's not a major deal. If we go back 6 months, it's kind of we're right in this window here, but that's going to roll over. The 3-month rate of change is flat, but it's still on a downward trend. I suspect some of this cash that came that we saw here enter the money supply from people selling stocks is going back in. Mainly today, which is very interesting, or this week, data shows that this was the second highest dollar inflow into stocks in history. Second highest. The market didn't go up that much. Where did that money come from? Well, it had to come from the money markets, which reflect here in the M2. So I suspect this will continue to head lower, and at the current rate in the next couple of weeks, we'll be back in the danger zone once again. Commercial industrial loans, they were just up 0.2%, nothing major. The back end number starting to go. I think this is peaking out if I'm right. That should spell dollar weakness coming forward. That should be very bullish for gold, something we're extremely interested in because, again, when you have central bankers that have no tools left in their belt, you got problems, and people tend to flight to safety. Gold and U.S. Treasuries, usually the two places they go. Credit cards, we see credit cards revolving plans on a year-over-year basis down slightly to 5.52. We see the trend headed down. This is not good. When consumers quit spending, as I said, the economic slowness in December, you can see it. It was building here as consumers stopped spending as much. They weren't charging much. You can see it. And eventually it happened. And we're seeing the continued trend, which is telling us the consumers are still tapped out. The Federal Reserve increased their balance sheet $2 billion for the week, which is negligible. They will unwind about $20 billion over the next 2 weeks, and then the third week they're going to have the third week will be $20 billion or more by itself. So that is to come. Bank deposit growth is flat at 1.6% year over year. Again, money's not going into savings accounts at a very quick rate, very low rate, despite higher interest rates. Not a good sign. It tells us, again, consumers are completely tapped out. More evidence that retail sales are going down in the future. This is was posted on Twitter by Teddy Valee, at Teddy Valee for those on Twitter. And this is a dollar volume growth of total spending trend from First Data Merchant Services, a credit card. And what this shows is credit card transactions in terms of dollar amount is falling back down to the 2016 lows when we were almost in a recession, when stocks were much lower than they are now. And so that's giving us an indication that retail sales are headed lower, not higher. And the last slide we've got here is Japan machine tool orders on a year-over-year basis. They're back to their 2016 lows, saying that demand for tool orders is weak. It's contracting. And again, with stock prices up, it tells you exactly why these corporate insiders are selling is because they know what's coming. They know exactly what's coming. So let's take a look at some charts, and then we'll kick back over to some bank data. I just want to look at the charts first and see what we got going on over here. So the S&P 500, and what would be a bullish move, actually cracked over this resistance line today and quadruple witching day. Keep in mind that the week following this is usually negative. So this is one of those days where you can kind of look and be like, well, I can't read too much into the equity market because people have to put their own money in to get their option contracts to pay off sometimes. So if you bought an option contract, say down here that the S&P was going to be up here, well, you need to buy and push this up. And then what happens after your option contract expires and you cash in or minimize your loss depending on whatever end you were on, then you start pulling your positions and sell. And that's typically what happens after quadruple witching day. The following week thereafter is usually negative. So we'll see. So I'm not reading too much into today's move just yet. I'm not saying this is a breakout to new highs. Potentially, if anything, you get up here to 2872, but I don't see it with a corporate share buyback blackout kicking in next week. That would be pretty unusual since the largest buyer of stocks is going to stop buying. It's going to be hard to think how stock prices are going to continue to go up. But let's take a look at 10-year Treasury yields. Now they're breaking down over their support level. So this was a 2.62. Let's zoom this out a bit and see. Yeah, there's this 2.62 level is real critical. And what happens every time it breaks it? Zoop, you get down to 2.3. Zoop, 2.3, 2.1. So you can see that this is a big move down. And when you still have record short selling sitting behind, a large, maybe not at the record, but there's a huge amount of shorts, you can get a big unwind that may even drive it all the way back down to pre-election levels. So we'll kind of see what happens there. But one thing that's worth looking at is let's overlay the S&P 500 with bonds. So there you go. According to this, with the S&P 500 being in purple, the S&P 500 should be trading around 2,400. Now, who's right? So here's what will happen. Either the S&P 500 needs to come down or interest rates need to go up. There's one of the two, and they can meet in the middle. But this dynamic does not continue for a long period of time. These are called what the industry will call alligator jaws. So an alligator jaw looks like this. Maybe in your view, it looks like this, and they eventually close. Mainly one side goes down, one side goes up. They rarely come together. So the question is, well, who's right? And the answer is, Well, the bond market is. And let's take a look at what's going on with the largest purchaser of Treasuries, the Federal Reserve H.8 data. And we can go look at the big banks, as we like to do every week. And here you can see they bought, not this week, the week before, $1 billion in Treasuries, $5 billion in mortgage-backed securities, and shed $4.5 billion of other non-mortgage-backed securities. In a sense, the banks are not unloading their bonds at all. So let's go back to the bond chart. And I have to bring you over there because I just flipped over there, but you're not. Okay, there you are. Now let's go and look. So at the week ending March 6th, and that would have been the 8th. So here we go. 8th. Where's the 8th? So the banks barely bought any bonds this week right here, and yields fell. So what does that tell us? The banks are buying bonds. They are not selling bonds. So if the banks were selling, we would know that they have so many of them that they could drive interest rates high very quickly. So the fact that they're buying tells us the banks are in the right position here because they have all the data. I mean, we've talked about this before, but they know how much money you got in the bank. They know where it gets spent. They know what you're charging on your credit cards. They know they know if you're on time with your bill. They know everything. And they know it before everybody. So why are they buying bonds? Because they know the economy is slowing. So it tells us very clearly that when these jaws close, it is more likely that stock prices close lower. Tells us that 2,400 is going to be retested. This is a support level. Yeah, here, I mean, here's a great look at just how closely these two run along each other. And you can see when yields go down and stock prices go up, something eventually changes, and so far that's been stock prices going down. So that tells us the Treasury yields are about to break down and pull a monster short squeeze here, driving them down, which should drive stock prices even lower, again, potentially back down or below their pre-election levels, which would be extremely interesting. 5-year yields, we'll zoom back out. They broke below this long trending support channel. Let's zoom that out and just see where it goes, just because I know I drew it in there one point. And, well, let's go to the weekly chart. Yeah, you can see support for the 5-year bond is right in this range here. So suggesting that when it breaks down, it's got at least down here to 1.8 to get to. So there's a lot of move down there. 30-year Treasury yields, they close below their 50-day moving average again. You cross over, confirm. So this was a false move up. It tells us again, yields are headed lower, not higher. And there's a strong line in the sand on the 30-year going all the way back over to here, which tells us that 30-year yields should be close to where 10-year yields are right now. So there's a big move down there coming. Let's keep going on. We got volume. You can see no major volume moves for months this year. It's pretty weak, so this whole rally is built on weak volume. And when the biggest buyer of stocks disappears starting next week, you can expect stock prices to likely head lower. Oil and gas producers, here again, we can overlay the S&P 500. Where did it go? There it is. And even if we zoom out a year, you can see very well connected. Again, this is telling us that the S&P 500 should be around 2,500. And what we can look at is oil and gas producing stocks close under their 50-day moving average. Again, they keep trying to get over it and they keep failing. Again, I keep saying it's a retest of the December lows. More likely it's going to break below that because there's not a lot of liquidity in the market and a lot of computerized programs that are going to continue to sell as volatility rises. And it's more likely that this is going to break below here and create a very cool buying opportunity for anyone who is not fully invested in stocks. Let's take a look at physical gold. You'll notice it's sitting under its 50-day moving average, this dark green arc. It's sitting close just over 1,300, right in this resistance zone. Has not been able to get over the top end at 12 or 1306. But when it happens, when it's under that 50-day moving average, well, let's take a look and find other points where it kind of broke out. Here's a good example. Broke out, came up, found his 50-day, rejected, found it again, boom. So it eventually came down to a support level. And here you can see here, bullish move up, came under, boom, came down to support. We can go back even further and we can find some other events where it took off up here, got under the 50-day, came down to support. Okay, to try to take off, came back under the 50-day, down to support. So this tells me that gold is coming back down, maybe only here to this 1240, 1250 range, possibly down to 1200. So this is not the bullish breakout we wanted, but what we want to see is if these are the smart money holding these positions down here. If they are, then prices should come to a stop somewhere between this support zone or this one. And that's how you know that the bull market for gold is on. It would make sense if it stops right in here, because rallies kind of begin, they pull back a range, and then boom, they make that next big move after that first what's called a wave, where it goes up and pulls back. So it'll be interesting to see what happens there. Let's take a look at the gold miners. They're just bouncing around. Again, they should come back down into somewhere in this $19 to $20 range. Would be nice to see this come down right back in here. Let's take a look at silver. Silver's stuck in its resistance zone. Can't get over this. Again, telling us that silver's going to move back lower. But again, we've got a lot of moving averages underneath here. You got the dailies. Look at this 50-day, 200-day, 100-day. We got the weekly sitting under here. We'll zoom in. So you got all, the weeklies are down here. So we got a lot of support for people who trade moving average. We got a lot of support from the support levels. So I like what we're seeing here. I think this move just was a little too quick, and with gold not following through, it makes a lot of sense why we've got at least one more pullback, and very curious to see where that stops. To me, that would give us opportunity to start buying in. Looking at emerging markets, I know we've talked about this as a potential opportunity here. It's got this support zone here. It's got to come back down and retest this range in here, or potentially this double bottom and form a triple bottom. We'll see what happens with that, but we got that on our radar as well. Looking at the 7 to 10-year Treasury bonds, you can see they are trying to break out here. All this, again, selling in here, selling in here, sellers up in here, starting to break out, cause a short squeeze, and boom, you've got nothing but some green space to move all the way back up to where it was in mid-2017. Looking at the long bond, you can see it running resistance, rejected, resistance, rejected, resistance, rejected, held the 50-day moving average after a day. It gets through here. It's got room to run as well. And let's take a look. I know we don't generally look at individual stocks, but I want to look at Tesla because they've got a lot of bad press. I want to show you what a topping pattern is. You can see here, once Tesla got over this, say, 275 level, all you see is large selling going on. People that bought it ages ago, sell, 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 sell. Now, Elon Musk bought right here between this 240 and 270 range. He bought here. Now, what's really interesting about what Musk did, he borrowed money to buy stock. And as soon as he bought it, he took a second loan against the stock to fund his lifestyle. The guy has a very high-end lifestyle. And what happens when CEOs borrow heavily to buy their own stock, they actually can get margin called themselves. Now, you say, well, Elon Musk is a billionaire. I'm sure he can afford it. Well, he just mortgaged all of his homes. So maybe he's not quite as rich as everyone thinks he is. So what happens is if Tesla stock continues to fall, Musk could get a margin call, and not only does he just have to sell it to meet one loan, he's got two loans, which forces him to sell more and more and more. And there actually have been cases where CEOs that were heavily leveraged on their own stock drove their company to bankruptcy. It happened last year, furniture company in Europe somewhere. So this is kind of interesting. So as Tesla stock continues to fall, Musk can get in a bind down here, and then all of a sudden you could watch the air come out of this company completely. Let's take a look at the ags. So finally something going on here where after heavy selling and on not much volume, now today's volume is nice, but in early trading there wasn't much volume and prices were moving up for anyone who was following it. It's simply because when you get enough people that are short something and you finally run out of people who are willing to short, it doesn't take much to push them out. And you can see these candlesticks. You had a green move up and a little short, a little selling back down. Green move up, a little selling back down. Green move up, a little selling back down. Green move, it closed at its high. So that tells us that the sellers are losing here. And that's kind of interesting because what are these sellers doing? They're trying to protect their short volatility positions, their long stock positions, their long oil positions, their short ag positions. Their short bond positions. They're trying to cover all these bases, running out of money. And so this one is losing some attention. And what's cool is we could see this easily starting to pick up some steam now because the bulls are going to look at it and say, hey, this is a nice move. And this volume here doesn't have to be a lot of bullish buyers. It could just be short sellers getting squeezed out of their short position. Because you see, look at this here. You had a lot of buyers here on this big volume, but you had a lot of sellers. Well, those sellers are getting flushed out because now all the people that sold here are in negative positions. And that's why I said this volume here was either starting volume, stopping volume, and I thought, I bet you it's stopping volume, and it kind of, whoop, now here we go. So it'll be interesting to see if this can keep garnering some steam, because if it can get probably back above the $16.90 range, this thing could fight through a lot of these shorts without much effort on the behalf of the bulls, just because they have people that are short here unwinding their short position. So pretty interesting, especially with this big storm hitting the Midwest. It's called a bomb cyclone or something. It's weird because I was going to show you the weather data, but you can't really see it in there. But this thing's supposed to bring lots of rain, flooding, and high winds. Again, flooding is not good for the farmers because they have to plant in ideal conditions. And coming April, May is major planting season, and people that are in that farming region are already saying the land is too wet. They said it's way better than it was last year this time. This is not good conditions, and it'll be interesting to see what farmers are doing. Again, solar minimum bullish for stock, or bullish for the ag commodity sector, because yields fall, land conditions aren't ideal, global crop supplies fall. It's all there, and you have record mouths to feed. So I'm Steve Van Metre. I hope you enjoyed the update. We'll be back on Monday, and we'll be interested to see what the after effects of Quadruple Witching Day are. All right, have a great weekend. Bye now.